Hello, my name is Richard Comotto. I'm a consultant to ICMA on all things repo, and one of my regular tasks is to conduct the ICMA's semi-annual European repo market survey. This podcast is about the results of the latest survey, which looked at the European repo market as of the 8th of December 2022. A report on the survey has just been published and is available on the ICMA website. But before I talk about the results of the last survey, let me explain its methodology. The first thing to understand is that the ICMA survey measures the value of the stock of repos outstanding on the books of the survey participants at close of business on the survey date. The alternative would have been to measure the turnover or flow of new transactions between two dates. Turnover tells you how busy a market is, but ICMA opted for the stock of outstanding repos because this gauges the exposure and depth of the market. Unfortunately, one consequence of adopting a stock measure is that it understates the value of short-term repo, as these run off between survey dates. Another important feature of the survey is that it measures repos and reverse repos, which means it includes both sides of a matched book. The survey also includes a repo from its transaction date, which is the date when it's executed and a contract is formed, rather than from its value date, which is when cash and collateral are first exchanged. This approach gathers in forward repos, which, as we'll see, are a major part of the European market. However, using the transaction date overstates exposure, as the risk on a repo before cash and collateral are exchanged is a marginal replacement cost and not the full principal amount of the transaction. I should also note that the ICMA survey doesn't cover repos with central banks that are part of their monetary policy operations. And the survey isn't adjusted for double counting, that is, where both of the parties to a transaction are participants in the survey and report different ends of the same repo. However, I estimate that double counting is unlikely to be greater than about 15%. Finally, it's important to remember that the survey doesn't cover the whole European repo market. For example, the last survey had 61 participants. So what the survey does is to fix the minimum size of the European market. However, as it includes most of the largest players in the market, the survey may be as much as 70 to 80% and is unlikely to be less than 50%. If you compare the ICMA survey with public data compiled under SFTR, the Securities Financing Transaction Regulation, you can see it's about 50% of the combined UK plus EU total. But the SFTR data, which is double counted as well, is inflated by the way in which CCP cleared repos are reported. So our estimate of the size of the survey compared to the true market looks pretty good. Now let's talk about the results of the last survey. The headline is that the outstanding size of the survey sample broke through the 10 trillion euro level to reach a record 10.374. This represents growth of 7.2% since the June 2022 survey and 12.8% year on year. You can see from the slide that these growth rates have continued the trend which has been followed since the COVID shock in the first half of 2020. Adjusting for new participants who joined the survey since June brings the growth rates down to 4.2% and 10.2% respectively, which suggests a deceleration in trend growth. However, the deceleration probably just reflects the usual end-year contraction of repo books, so-called window dressing. Window dressing describes market intermediaries shrinking their balance sheets in order to reduce regulatory ratios, liabilities for charges such as banking levies, and other calculations that could increase their costs. The impact of year-end on the behavior of the repo market is one of the two big stories of the December 2022 survey. So let's take a look at that. Back in the summer of 2022, forward prices suggested that window dressing at the end of the year would be unusually severe because of a glut of central bank cash and a consequent scarcity of collateral. However, things turned out to be quite calm. I'd recommend that you read Andy Hill's year-end summary, which you can find on the ICMA website. As Andy explains, the reason for the smooth end year was that measures had been put in place by both the authorities and the market to mitigate the expected problem. For example, the German DMO reopened 18 bond issues to create extra securities to relieve collateral scarcity. And the ECB incentivized the deferral of TLTRO payments to relieve demand for bank balance sheets. The measures taken by firms included the usual increase in long-term trades, reflected in a recovery of the weighted average maturity of the survey to between 31 and 70 days. Firms also moved into forward repos, which surged to a record 20.2% of the survey total. That's the column on the right-hand side of this chart. Some of these forwards were to lock in future interest rates against expected increases by central banks. Some would have locked in future supplies of cash or securities over the year end, but many forwards were created by breaking up long-term trades into two transactions, with the first one maturing on the 2nd or 3rd of January in order to maximize opportunities to net year-end balance sheets, while the second ensured the diversification of the final maturities of assets and liabilities. In addition, we saw the usual seasonal recovery of securities lending done on repo desks. This may be the result of securities-driven repos being converted into securities loans against non-cash collateral in order to reduce the balance sheet impact of such activity. Returning to the other results of the survey, if we split balances into repo and reverse repo, you can see how since 2010 and the Eurozone sovereign debt crisis, the survey sample has been a net lender of cash and therefore a net borrower of securities. And this may be the better angle from which to look at the repo market since 2010, given the shift to securities-driven repo trading since that time. The size of net cash lending is now equivalent to a record 6% of the survey total. This is the result of a trend growth in gross lending and a trend reduction in gross borrowing, which both likely reflect the rising tide of central bank liquidity since 2010 and the consequent growing scarcity of collateral. As monetary policies normalize, it'll be interesting to see if and how this balance changes. A more permanent feature of the survey that we can see if we look at the maturity profiles of gross lending and borrowing is that the survey sample ran a negative funding gap, that is, borrowing cash short term and lending it out longer term. Such maturity transformation is, of course, one of the essential roles of the market intermediaries who make up most of the survey sample. The survey also shows that most net borrowing is for 7 days or less. Other survey data shows that this borrowing is highly seasonal, shrinking at year end and recovering by the time of the June survey. Net cash lending is concentrated in the 3 to 6 month maturity band, as well as in open repos and in forward repos, all of which are highly seasonal, but in the opposite direction to net borrowing. There's also a lot of net cash lending in the 1 to 3 month maturity band, but this is non-seasonal. We can also see that net cash flows into the survey sample from counterparties in the tri-party market and from outside the survey, and flows out through direct transactions. Net flows of collateral, of course, move in the opposite direction. The direct market, which is sometimes also called the OTC market, is the largest segment of the repo market and has outpaced other segments in recent years. This is where business is done with customers against non-government collateral and in larger, longer term and structured repos. It is, as a result, a higher margin business. In net terms, the direct market is a lender of cash and a borrower of securities. Going back one slide, You can also see the secular decline in voice brokered repo over the 22 years of the survey, and how the share of automatic trading systems, or ATS, plateaued in 2012 and has drifted down since 2016. Now, as regards the voice brokers, it's generally accepted that they've been disintermediated, at least in short-term government bond repo, by the ATS. On the other hand, the share of ATS has been suppressed by the very short-term nature of repos traded on these platforms. In contrast, in turnover terms, they've been booming. Just look at this data from BrokerTech, which is one of the leading ATS in the European market. Let's go back again to the earlier slide to see the second big story of the December 2022 survey, which is the collapse in the share of tri-party repos from 9% of the survey in June to just 6.5%. The loss of share, by the way, was matched by a shrinkage in the value of tri-party repos that was reported by the principal tri-party agents. So it wasn't just a question of other segments growing faster. It's been suggested that the decline in tri-party repo, which are cash-driven repos mainly between dealers and non-dealers, reflects uncertainty about further central bank rate hikes, and was aggravated by the shock of the UK mini-budget in September, which caused lenders to withdraw funds. Uncertainty reflected in volatile securities prices also resulted in a significant and across-the-board increase in tri-party collateral haircuts. However, there was one exception to this story of tri-party decline. The GC financing market, where trades are both CCP cleared and managed by a tri-party agent, kept pace with the survey sample and so increased its share of tri-party repo to 25%. The reason may have been the standardized collateral baskets traded on GC financing facilities, which make it easier for its largely dealer user base to run trades until the dates of expected rate increases and then roll over those trades at new rates. In net terms, cross-border trades, especially those into and out of the Eurozone, fed cash into the domestic and anonymous markets and took out securities. The share of anonymous repos, which means CCP cleared repos, where the initiating counterparties are hidden from each other by the CCP, mirrors that of ATS repo, which is not surprising given that 95% of ATS repo are CCP cleared. So while the share of the survey looks lackluster for CCP cleared repo, the turnover has been booming. Consider the monthly turnover on LCH Repo Clear, the largest repo CCP in Europe. December, of course, was hit by year-end window dressing. So to conclude this podcast, let me run through some of the other results of the December survey. First, the share of government bonds within the pool of European collateral increased to 91.5% from 90.7%. This was the net result of increased balances, mainly of German securities, which have reversed their secular decline in share that has taken place until 2020. But it also reflected increased balances of Italian and Spanish securities, and a reduction in the trading of UK gilts following the sell-off by LDI pension funds that was triggered by the September mini-budget. As would be expected in an environment of rising interest rates, floating rate repo have continued to increase share. By the way, the fall in the orange line there is open repo, which has been moved into another classification. And finally, the introduction of new participants into the survey increased concentration of balances within the survey sample. So that's it. The next survey is due to take place on the 14th of June. I hope this podcast has been interesting. Thank you for your attention.